lot of institutional clients have been asking about a potential bounce. So I know you kind of walked through the trade and trend setup on the SPX. What would you be looking for as the difference between a bounce to fade and a bounce to buy?
A higher low on the S&P 500 and an immediate term breakout on a trade basis on the trade duration. So again, that just like we told you how to do everything. If you reverse it, it's consistent, right? So what did I say, Emma, on how do you identify a bubble and a bubble eventually popping? Well, one, it makes a lower high. Write it down. The risk range makes a lower high. Two, it breaks immediate term trade support. Three, it breaks trend. You got a trifecta on the S&P, NASDAQ, et cetera, on those three things. Now, reverse it. What would make something, what would arrest something's decline initially? One, a higher low in the risk range, which you don't have in the S&P 500 today. Yesterday was 55.70. Today it's 55.26 at the low end of the range. Two, and again, I'm just answering it using the S&P 500. You need an immediate term trade breakout, which would you need the S&P 500 to close above 59.08. 59.08, right? Not it's at 55.72. And then the trend breakout, which would it'd have to break out even above that. So, that's I get it. I get that. That's generally the question people want answered after risk happens. But it's day to day. Like I said, I could answer 10 questions in 9 minutes. To me, the game is very clear right now. It's not complicated. What gets complicated, Emma, is of course if somebody doesn't have the process to answer the question the way that I answered it, in terms of something breaking down or arresting its decline.